me know when.
Cool. All right. So, Stephen, now that we've kind of addressed this, what your landscape is for some of the best yields, what do you think is the most overlooked opportunities in the space as far as yields go? Is there something special that you're seeing that you can share with us without getting diluted if you've already been?
Yeah, so I'll give two. One was the RLUSD loop on Euler. I mean, it's still good. It's 31% net APR. That's what I'm getting, but I'm not max leverage. You can, I think 14. You could technically 20x leverage. That's kind of a secret if you do it yourself. But if you do it through Euler multiply, you can get 14.27x leverage, 31% to 30 to 40% APR. And again, that's like dedicated yield from Ripple. They're just giving you more RLUSD. So you don't even have to be exposed to XRP if you don't want to be. And so I've been farming that. I like that. But another one is the Pendle. I mean, I think these might be undervalued. The Pendle YTs for USDS. So, and the reason why is because it's really, really hard to understand. So Spark has these seasons, and they have 2 pre-seasons before year one. Year one, they're giving out 1.67 billion tokens. And out of those 1.6 billion tokens, season 1 accounted for 20% of those. Season 2 is going right now. And season 2, the only way to farm it is through Pendle. It's the only way. So either LPing USD, the USDS, SYUSDS, or PTUSDS, SYUSDS on Pendle, or buying the YTs. That's the only way to farm this current second season. And if that's 20% in size, then you kind of have to estimate what you think the FDV of Spark will be. But at any reasonable valuation of Spark, I think it's could be undervalued by like 50%. Because my estimates have it between 18% to 36%. I mean, if you could go up to $500 million valuation of Spark, I really don't know how to value Spark because, you know, what's the other one? Sky is 1.5 billion, Maker is 1.3 billion. Spark is like the bread to Sky's butter. So I'm putting it, you know, mid hundreds of millions. And that means if Pendle really does capture this 20% for season 2, which is the last season before the token launches, then it could be buku money. And so I don't know if you know Nomadic and DeFi Dad, but they've been like in the trenches farming this pretty heavily. I know they're top in the leaderboard, but I like that one. I think in terms of hidden gems, that's one of them. And the reason why it's a hidden gem is because it's so hard to understand. The harder a yield is, the harder a point is to value. Typically, the more bang there is for your buck there.
Yep, absolutely.
Stephen, I'm curious what your greatest yield ever has been. Like, what's been your greatest farm ever? What was the setup for that?
I'll give you a couple of my home runs from the cycle. I guess technically we're a cycle past, but I still think like Points Bonanza is still the same cycle, even though I know technically that was like 2023 and we're almost 2 years past that. But when LRTs first started, so this is like Wrapped EtherFi ETH, Renzo ETH, all of those, there was no liquidity. You couldn't enter and exit. You could only go in. And I said, well, these are fully transferable tokens. I'm just going to make the liquidity. So I went on Uniswap and spun up 1% fee tiers for like EtherFi ETH, Renzo ETH, Pufferfi ETH. And all of these for the first month were printing multi-100% APRs because they were my liquidity was the only way people could enter or exit. And so that, to me, that was a massive home run. And I benefited from that tremendously. Also, just being early on things like FFX, so FXN, have been really good. All the airdrop campaigns, like season 1s were outstanding. So EtherFi season 1 was awesome. I did really well on Hyperliquid just because they messaged me really early and they're like, hey, try out our new decks. And I was like, you know what? Okay, I'll use it to hedge. Your funding rates are pretty good. And I was doing like funding rate arbitrage really heavily back then. So I was like, and anyone in the Discord, use my ref link. And they all did. Of course, me being an idiot, like I distribute my reflink stuff to all my mods and myself. So I was like, okay, let me just sell my hype on day one, like distribute it. And then it like 30x. And I was like, oh my God. That was painful for sure. But that was a lot of fun. I think those were probably my biggest wins. Also, I did a ton of arbitrage on, what was it? Mantra chain. There was Stone. So Stone is like a form of wrapped ETH, but you could, I was LPing at 1%, like Aperture Swap, which was really, really good. I was also arbitraging it because it was under peg since it was a lock campaign. You couldn't exit yet. And so I just like, okay, well, I know it's going to be unlocked on X date. If I just buy it under peg and then unwrap it at that date, I'm making an implied 40% APR. And if I LP it until then, I'm getting that 4% implied APR plus, 100% APY and LPing. So for those in the trenches, there have been some really, really good yields.
It's incredible. And Steven, before we let you go, quick question on this. Kind of gets back to the two wolves here. One is obviously fighting for the best APR and the best rate of return, and then you kind of have the other that is, trying to have a more balanced approach. And it sounds like a lot of the strategies here are to maximize yield on stable coins. So you're not really taking any risk of depreciation on these assets, maybe some depeg risk, but there is, some smart contract risk going into experimental DeFi protocols. How do you balance, the token variables going up and down with some smart contract risk? If you're going in on stables, you're thinking, okay, these are going to be stable, but going into smart contracts has some element of risk. How do you assess that? And generally, do you ever price that in to your expected return so that you can kind of, take into account how that may affect your yield?
Yeah. I mean, I'm sure you guys are in the same position where you probably get 1,000 Telegram DMs or Twitter messages a week saying like, check out my stablecoin, check out my, and so many of them are too exotic for me. Like if I'm in a stablecoin yield, it's got to be like, for example, 𝘰𝘭𝘵𝘐𝘬𝘐, they already run like $1 billion off-chain fund with treasury bills. So them coming on chain is like, okay, I trust you guys, and if something bad happens, you'll probably do a compensation program. Other protocols who are like brand new stablecoin, we're using a novel mechanism. I'm like, that's fantastic. I love it. I love that for you guys. Wait until you guys get Lindy. Let me see this. Let me see the audits. But a lot of the time, I'm looking at oracles. So when I'm going into a strategy, oracles are king. I need an NAV or fundamental oracle, which basically means I can't get liquidated if there's a market price fluctuation. This means that the borrower and lending protocol or the curator of that market is taking on the risk while giving me all the benefit. I love that. I'm happy with those. My only liquidations this cycle have been because of market rate oracles. I was leveraging wrap staked ETH, one of the time-tested leverage strategies for ETH yield. Still fantastic, by the way. Here's some alpha. Aave Prime. Oh, my LPs are going to get mad at me. Aave Prime wrap staked ETH looping is the most profitable form of looping wrap staked ETH on Aave. It's like you have to go around and click and navigate to it. The Aave main market is a little bit worse because the ETH bar rate is typically like 30 bips higher. So if you want to get like a 15 to 20% yield, you can literally set and forget for years. Aave Prime is the best place to do that. But oracles, yeah, definitely. Like you look at your oracle risk, always know which stablecoin you're dealing with. I think people, if they really looked under the hood of USD 0++, usual's USD, the one that depegged because everyone was like, oh, this is a 4-year bond, it's not a stablecoin. They would have been able to mitigate that risk. Also, like if you're on Frax Chain, shout out to Sam, he's amazing. But like they have FXBs and they have a 30-year bond. And so if someone bought that thinking it was a stablecoin, it fluctuates by like 5 to 10% daily, just because there's so much premium on it. You have to really know what the underlying stablecoin is, and then yes, it's a totally different degree of analysis and time. But luckily, right, you can look for like where's the most TVL, what's on Pendle, where are the places to deposit, what are my oracles? Okay, I've mitigated a lot of the risk. Let's go ape.
Yeah. I mean, we also recently saw that Chainlink was getting under fire by some of the Chaos Labs people because of that thing where they were blaming Chainlink for not having the proper functioning price updating tool effectively. But Chainlink was like, it's not our fault. It's not the Oracle's problem. But you can just constantly see that is where that's why Aave uses Chainlink. That's why you have to trust your Oracle more than anything. You know what I mean? So.
Oracle extractable value is an entirely different conversation that you guys should talk to Brian from Compound about, or Alpha Growth.
Yeah, it's a wild it's the wild west still in that landscape.
Absolutely, it is.
Last thing I got for you, Steven. If someone new is listening to our channel, wanting to do participate in DeFi, get active, what would you say is the minimum starting amount, and how much time, and kind of like where do they go to start?
Totally depends on what their thesis is. So the important thing about DeFi is like know what your thesis is. Are you looking to turn $1,000 into like $1 million? If so, you're going to be in the meme coin trenches. That's basically the only way to start with something small and go crazy with it. Altcoins, meme coins, not just get lucky on some of those and do a ton of work. If you're looking to get passive income, then I think even 10K is reasonable. Now I know it's like a high benchmark for a lot of people, but it's better than a savings account. If you're gonna have a savings account anyways, you might as well be getting, 8% to 15% on Pendle. Fixed rate, fixed date, low risk. Just set it and forget it. On bond, put it back in the next bond. that's super, super simple and probably more approachable for most people than T-bills. And if you want to use the value of your underlying PT, you can throw that PT on Morpho and borrow against it. Yeah. So you have also the composability. I think that's probably pretty approachable for most new people. And of course, if you want to like really get passive income, that scales. I think like there's that really, really good scene from The Gambler with Jeff Goodman. Is that his name?
Yeah.
Yeah. It was like any fool with who makes $2.5 million with a brain knows, you know, and then you put it in a low interest savings account and you do that. And if you can do that on Pendle, if you can do that on Morpho, even the Morpho Gauntlet vaults are really good. They're 7% for months on end. There's so many highly liquid places you can beat T-bills. And I think if you can beat T-bills and maintain your liquidity, that's huge. It's massive. And that's probably the lowest barrier of entry for most people. If you're looking for delta, if you're looking for those huge wins, you're looking to double, triple, like quintuple, 10x your initial investment, you have to be able to find value, and that takes fundamental analysis. And to do good fundamental analysis, I don't know, like open up your favorite LLM and just start asking them questions. And just like take a very tiny amount of money and start looking at altcoins and investing in them. And remember, it's going to go up and it's going to go down. Your bet is that it's going to go up more than it's going to go down over a long time horizon. Don't try to day trade; you'll get torn to shreds.
Steven, thanks for joining us, man. Shout out to the DeFi Dojo. Absolutely crushing it. You guys have been doing great work. So I appreciate you coming on. And I mean, we'll come find you in the dojo Discord, man.
It's been a pleasure.
Thanks, Steven.
Cheers, man. See you next time.
That's where every single possible good yield is. I'll tell you what. If I'm a hungry yield farmer, I'm going to the DeFi Dojo.
Absolutely. I mean, I feel like that kind of gets lost in the sauce a little bit when you see everything that's happening on chain. It does kind of feel like, hey, I've got to get into meme coins if I want to make any significant return. Meanwhile, the real alpha here is in the yield that you can get passively on chain. And it does take a little bit more of a capital base, but I think, to Steven's point, you can start to couple some of these, right? And okay, yeah, maybe I'm only going into this vault to try to, beat T-bills. But if I can couple that with getting an airdrop because I'm early into a protocol, you end up in the next Hyperliquid.
Well, yeah, I mean, that's why I feel like there's a lot of the DeFi alpha is actually in positioning into things that drive yield and then set you up for future tokens, basically. I mean, that's like a lot of his strategy. That's why his biggest wins were those LRTs, right?
And for so long, it was that the protocols themselves were the product. Now we've gotten into, okay, the tokens are the product. But yeah. I think we're starting to get back to real product market fit and finding real protocols that drive real value. And that's where the hunt is.
Up next, we got Jackie. I met Jackie in the city a couple months ago, maybe like 1 or 2 months ago. She runs an awesome podcast, was just in London, I think, at the Avalanche Summit. And let's get her up here. Hey, Jackie, what's up? How are you?
Hey, how are you? I'm good. Yeah, it was good seeing you in New York. I was in London and now I'm back. I'm staying in New York. No more conferences for right now. So I don't know if you guys feel the same, but I'm good.
Yeah, every week in New York is a conference, it feels like.
Yes. Luckily now everything is stateside, local, so pretty good. But yeah.
So how was London? Did you guys have a good event? I saw from the photos, it looked quite nice and you had some pretty awesome interviews as well.
Mm-hmm. Yeah, so it was the Avalanche Summit and we work with them at Token Relations, and Crypto in America was also there, the other company that I run. And so we were able to do some, fireside chats, live podcast recordings, get to talk with people in the ecosystem. And it was always a great event. They always host really good events. It's like festivals, honestly. I feel like to do a good crypto conference, it needs to be vibey and Web3 themed and cool, not like a big auditorium with bright lights. So they killed it.
Definitely. That's how, crypto breaks out of its echo chamber. And I think you did a great job of that, with your most recent episode with Vlad from Robinhood. I wanted to ask, what was it like? How did you end up, having Vlad on the show? And why do you think it's important to sort of pull in some of these, what we call mammoth founders, these people that have crossed the chasm?
Mm-hmm. Yeah. So bringing Vlad on the show was kind of like interesting full circle moment maybe, because like we had the conversation early in May and we recorded the day after Robinhood's Q1 earnings, which was not intentional. I'm not going to act like we are like geniuses on scheduling. We were just like, oh shoot, like they had their earnings yesterday, let's talk about it. It was great timing and awesome that Vlad was willing to come on a day after that. But honestly, for us, the reason I said full circle is because Robinhood was one of the first apps that I used to buy crypto like years ago. And if you remember, and you've been in the space for a long time, there was a moment where they removed a lot of assets due to like an SEC Wells notice that they got. I mean, we spoke about that on the episode and like, what was it like at the time to do that? Do you have any regrets on that front? The lessons learned there. Same with the GameStop craze and everything that was going on. But then we also talked a lot about tokenization and like what the future of that looks like and the role that Robinhood wants to play. And also revolution on tokenization. And they have been really hammering that home. And so like, if you see a huge push from them on this front, I would imagine you're going to see the same with other exchanges.
You know, I think they're actually gearing up to launch or to do a big announcement around a chain, and like their big push in crypto. I think it's going to be around like EthCC and CAN. I don't know if you have any more information about that, but there's definitely been some rumors circulating around their chain and like who they're choosing and all that kind of stuff. So just good to see them getting more involved.
Yeah, 100%. I don't know anything on the front of those rumors. He was pretty tight-lipped when it came to anything future-based. We kept asking like, okay, well, what's next? What are you guys going to do? And he's like, we'll see, you know, so, but yeah.
In general, this is sort of starting this integration of TradFi and DeFi. As we see, you know, Robinhood and Kraken, some of these guys are starting to launch their own chain and go deeper into DeFi. And then we see from the DeFi frontier, they're pushing further into TradFi. Ultimately, these two worlds are becoming more and more integrated. As you talk to policymakers, people that, you know, are kind of overseeing finance in general, what has been the temperature like? What is the sentiment like? Do they see these as industries as one and the same, or are they really kind of trying to build them out in parallel?
That's a good question. For policymakers, I think there's two sides to the coin. They're looking at digital assets and then blockchain technology. I think they are probably separate in terms of the way they will approach them and the frameworks that will come. Obviously, we have, you know, the Genius Act, which is focused on stablecoins, and then market structure bill that's being discussed right now. With both of them have ideal August deadlines, so like hopefully that actually happens. TBD, people seem optimistic. It's June right now. We still got like 2 months. So on that front, that's kind of what we're seeing. And then in terms of like policymakers understanding this, I think a lot of them want it to be bipartisan now, which is great for the industry. And I've always said, like, when it comes to technology, it's not really supposed to be biased. Like, tech is exactly what it operates as. It's not a person. It doesn't have feelings. The way people use it can be misused, of course, but like the same with the internet. And when the internet was first created, people acted like it was going to like ruin the future of, I don't know, newspapers, radio, whatever it is. And it sounds so silly now saying that out loud, but I think, you know, tech enables innovations and for people to operate in the future. And I think the policymakers are seeing the same.
Yeah, it certainly seems that way, especially this administration has been opening their arms to crypto and bringing it further into the Overton window of acceptable finance. And stable coins are a big part of that. Is there any overarching themes that you've noticed, any through lines here? Generally, as you've spoken to quite a few founders and decision makers in the space, you know, what has been some of the more impactful and influential things that you've heard from these founders and from these policymakers? Is there anything that sticks out?
Mm-hmm. Yeah, I think it goes back to like, it's about technology and getting the policy right. It's not meant to be a partisan issue. And we actually just had Anthony Scaramucci on to record. That episode comes out on Wednesday, but he was joking about how Elizabeth Warren likes to present there's like this anti-crypto army, but like nobody is an anti-crypto voter. No one feels that passionately about hating crypto so much that that is their one issue vote. Whereas on the flip side, there are people who are fully crypto voters. We saw that with President Trump's election and, you know, win in the end. And I think that's something that's really tapped into right now. And I think some of the most interesting insights in the conversations I've had from our guests have been like the funny little anecdotes we hear about these people. Because a lot of times, like you think of like Gary Gensler or, SEC Commissioner Hester Peirce as like just, these faces. We see them come on TV, they say their little lines and they get off. But like, what are they actually like behind closed doors, right? What about the new CFTC commissioner? How do we think about that? What about these people making the laws? And so a lot of times our guests come on, they get comfortable and on the show Crypto in America, and they talk to us about like what it really is like to get to know them behind closed doors. Like Patrick McHenry told us that like Gary Gensler actually didn't hate crypto. And we were like, damn, like,
he
and all
was
that
actually advocating
right?
for it at MIT.
Yeah, he was.
Yeah. And so it's like, when you hear these things and they're validated like behind closed doors, and like you get these anecdotes of like what they're really like, it kind of changes your perspective on things.
Jackie, I have one more follow-up on this note, because I'm really curious about the Elizabeth Warren example. You mentioned that there's no there's no anti-crypto voters. No one hates it that passionately.
Okay.
But you see Elizabeth Warren vehemently hate crypto and advocate against it in
She's
the
a
Senate.
voter.
So
she is a voter. Yes.
She is a voter. And like, who do you think she's representing? Like, where does that anti-crypto cabal come from? Is there anyone, if it's not her constituents, is there other cabals behind the scenes that are pushing her in this anti-crypto direction?
We got to get her on and ask, but I would joke people who got rug pulled and lost everything, like maybe you hate crypto that much. But in all seriousness, the reality would probably be just people who don't understand it. But like, again, ignorance doesn't really make me vote towards something against crypto. Like there's things in life that I don't fully understand. Like I'm not well versed in certain topics, but that wouldn't make me go out and vote against them, right? So I don't know is the answer. I don't think there is an anti-crypto voter unless it's someone who just lost all their money in crypto. But again, like, it's part of the game.
Yeah.
It certainly seems that way.
I mean, she's just, yeah. We don't even need to get too deep into the politics.
She's leader of a cabal that doesn't exist.
Yeah, in her own mind. Kind of zooming out from the policy here, Jackie. Obviously, you have a really cool business in token relations. That's why you're in London, and you guys have basically been trying to solve and reason about this third bucket of information. I'm curious, like, what were the gaps in communication that led you to founding Token Relations? You're working on it with Pomp. Would love to know the story there, and what made you guys pull the trigger on starting this business.
Yeah, so Token Relations, separate from Crypto in America, started about over a year ago now. And essentially what we were trying to do is build a place where blockchains, protocols, and projects can get to know their ecosystems all in one place. An example I give is like, sure, we were at the Avalanche Summit. And like, if you're not in the Avalanche ecosystem, where do you go to learn about what's going on in there? And if you are in it, where do you go? You probably go to Twitter, Discord, Telegram, maybe their website. But I just told you 4 different places to go. And none of them might be guaranteed in like getting the results that you actually want, right? So it becomes more of like a fragmented experience, right? And the way I thought about it when I was a reporter is like I get so many pitches to my inbox. Before starting Token Relations, I was at TechCrunch. And before that, I was at Blockworks. And the problem is like I would get so much inbound, and it wasn't like these things weren't important. I was just one person. I only have so much bandwidth. And like there's other things that might stop me from covering a specific announcement. And so what if we could take all these things and put them within one place so you could get up to date on a bunch of different ecosystems? And that's essentially what we've done. We work with some of the top blockchains in the ecosystem, from like Solana to Avalanche to Say to Injective to Polygon, Aptos, you name it. And so what we do is really just put it all in one place, make it understandable, make it accessible, and really give the ecosystem a way to be educated and more long-term thinking. And then if you don't know about it, you can also learn. So
sweet.
That's the deal. Yeah.
And how did you meet Pomp to start this business? What's the lore there?
Yeah. So I was a reporter for a long time, as you know.
Yeah.
And I covered an exclusive for him years ago. And then we touched base probably almost a year and a half ago now. I'm trying to think. Yeah. At the beginning of 2024. And
wish you the best with Token Relations and with Talking Tokens as well, and Crypto in America. You're the only person that I know that has like 2 podcasts. So good luck.
Thank you.
Keep
I
up the great
appreciate
work.
it. Yeah.
And see you in the city soon.
Yes. Thanks, guys.
All right.
Cheers.
Bye-bye.
Thanks, Jackie.
Yeah, they're doing great work. I mean, she has just the pulse on. She has the pulse on Crypto in America. She has a pulse on some of the bigger L1 ecosystems. They have a good data product. So, yeah, it was fun. The Elizabeth Warren comment was pretty funny.
Yeah, I think it's a pretty pertinent observation that there are no anti-crypto voters. So who is Elizabeth Warren really acting on behalf of? It just doesn't really make a ton of sense. Like, she's out there.
Constituents, man. The constituents.
She's acting on the constituents that don't exist. They exist in her mind. She thinks there's this anti-crypto sentiment out there in the wild. Look, people don't want to get scammed. I understand consumer financial. I do think that there are people now that look at crypto and they're like, oh, this is just a way for Trump to enrich himself. And people are, bribing him through his meme coin. And they're basically buying up the meme coin, proving it to him, and then getting a backroom deal, or making an investment via his World Liberty Financial stablecoin. I could see the outgrowth of a segment of the population that does have this disdain towards crypto as a result of a disdain for Trump. Oh. I am. Yeah. Look, normally I let our good friend Arthur Hayes, our resident macro analyst, ask the macro questions. But yeah, I'm since he's not here, I'll step in as the macro analyst. I'm excited to talk to Felix because I have kept up with some of his takes. I think he's great on forward guidance, and I think he's got a finger on the pulse of macro these days. And there's a ton going on. Look, I for one, did not follow macro for too long. And I think now, it's just unavoidable because you look at the dog wagging the tail of crypto. How can you not look at overarching liquidity conditions as an indication of where crypto is headed? If you want to look at, is crypto going up? Is it going down? Is it going to go sideways? And when? You have to look at the bigger liquidity picture. And I think macro is just that. So I'm extremely excited. We're going to talk to Felix about obviously the interest rate environment, the trade after the trade, which means, the initial trade once there was uncertainty was gold. Gold flew, and following gold doing quite well, Bitcoin came in and did quite well, bouncing from the bottom of about 76,500.
Yeah, what's funny is I had Jordy on, and he talked about it as well. Jordy Alexander from Selene. We spoke about how there's a couple of times in the year to kind of pick money up off the floor, and that 75, 78 level was part of it. So I think we're about ready. We'll get him up when he is up on the stage, get him into the meet. Felix, good to see you, man. Thanks for joining us. Big fans of your podcast. Also had Arthur Hayes on at a similar time that we did when he was giga bullish and everybody was not. So it's good to see you, man.
Yeah, thanks. Happy to be here. Big fan of you guys.
Let's make sure you're unmuted in Google Meet so we can hear you.
Oh,
there
we go. You guys
Welcome
hear me okay? Nice.
Yeah.
Yes,
thanks.
Sir.
Yeah, happy to be here. Big fan of you guys' work, and excited to chat.
Yeah, man.
Thanks, man.
So Robbie is our local macro analyst. Guy listens to the All In podcast. He listens to Forward Guidance. He listens to all of Besant's speech. So I'm going to sit back a little bit on this one and see what Rob's got for you, Felix.
Sounds good to me.
I don't have anything too specific at this point. I do tend to think of macro as the dog wagging the tail of crypto, because it's just, even if you're looking at the crypto asset class and maybe it's, you know, a few trillion, that's pocket change in the grand scheme of things. And so the bigger liquidity picture is what leads the charge and kind of dictates the show. So when you think about this, is that really the case? Can crypto do well despite, you know, global liquidity coming out of the system? And then maybe we'll get into, you know, whether or not you think liquidity is going to be added or taken out of the system.
Sure. Yeah, I'll start off by saying that I think there's too much of a focus on within the realm of global liquidity in terms of what the Fed and central bank policymakers are doing. I have completely shifted a lot of my macro focus towards the fiscal side of things, because that has actually been the driver. And that is why you've seen Bitcoin do so well since 2022, even though we've seen the fastest hiking cycle in history. That is very counterintuitive. And that's also at a time where we've seen the US dollar absolutely surge as well. And I think that caught off guard a lot of different people, because they were too focused on, oh, the Federal Reserve balance sheet is coming down, they're doing QT, they're hiking rates, there's no way we can have a risk on environment for crypto and Bitcoin. And the last few years have completely proven that case, that we can. And that's because we're living in this world of, you know, you've heard it called fiscal dominance. And I don't know if I'd go as far as that, but I would say that we are, you know, heavily at the whim of the fiscal impulse now. And that's one of the biggest drivers that drove my bull thesis for Bitcoin back at the lows of April, was looking at the fiscal dynamics of things. So I totally think that we have a lot more upside from here based on those fiscal impulses. And we can get into that if you'd like. But overall, I would say is that, you know, it doesn't quite matter as much what the Federal Reserve balance sheet is doing or what the Fed is doing. You can quantify it, and it's been a bit of a sideshow compared to what's really driving things, which is just these huge fiscal deficits that have been running in the U.S. since COVID. They've had the largest fiscal deficit, and now we're in the point now, and this is something I talked about in that original Bitcoin bull thesis, is that now we're having every other country in the world start to join the party as well, and they're going to increase their deficits.
Yeah, we had Arthur on the show, and we also brought up with him this question where we had seen Scott Bessent say something that, you know, the countries that are in the deficit versus the countries in the surplus are actually in the stronger position when it comes to trade talks, because the consumer buying power exists here. And we can always, you know, bring the demand to another supplier. And so, you know, when you're looking at the deficits, who do you think is in the stronger position when it comes to some of these trade negotiations? Do you think these really just a song and dance to try to, you know, continue the narrative, or do you think there's a deal that's going to be done here?
So I think it's been an interesting sequence of events where, you know, I was talking there about the fiscal deficit. Now we're talking about trade deficits, which are, you hear this talk about twin deficits. That's what we're referring to here. So speaking about the trade deficit side of things, we've seen this interesting sequence of events where when the Trump admin came in, there was a lot of focus on the current account deficit, which is goods coming into the US and then dollars going out. And that mechanically leads to a capital account surplus on the other side of things, because those dollars are going to the rest of the world. And then, you know, for the goods that are coming into the US. So that is the mechanics behind why you've seen such a huge current account deficit. And now we're in the situation where they want to find a way to rebalance the terms of trade or the balance of payments. And so the original approach, Liberation Day, was all about tackling the current account deficit side of things. Let's put on a bunch of tariffs so that we can narrow down the current account trade deficit, and therefore also narrow the capital account surplus, and as well as the current account surpluses of those other exporting countries like China, et cetera. So it's been this interesting situation where we've started to see the limits of that approach. We've seen how, you know, you can't just go out and just tariff the entire world. There's diminishing returns to that approach. So we've seen them, you know, originally Liberation Day saw 30% effective tariff rate. We're now with this walking back at around, I think, 15-ish%, assuming that the litigation in the courts remain and those tariffs actually stay. We're around 50%. Mm-hmm. And I think that's a level that global trade can work around and digest and alter to, but I think there's limits to that approach now. So I think what's really important, this is something actually Arthur Hayes wrote a piece about recently. I don't know if you talked about it on the show, but he's been on top of this, which is, well, what if we focus on the capital account side of things? What if instead of just trying to tariff goods and squeeze the consumer, we just lower the capital account surplus side of things? And that looks very different, and it squeezes very different people. It does not squeeze the consumer. It squeezes people with a lot of assets, especially foreign asset holders of US assets. So we've started to see hints of this start to percolate in first off, the fiscal bill that's going through right now. There's some hints in there where they're talking about taxing remittances from the US to the rest of the world. There's a lot of these different cross currents. And I think this is a much more tenable approach to what they actually want to achieve, which is basically they want to narrow that deficit one way or another. They can go about it with the tariff side of things. We're seeing the limits of that now, and that's pretty much played out. So I think we're going to see this pivot towards the capital. I'm talking about capital controls here, really. I'm saying that let's put up, headwinds to make it so that people don't want to own U.S. assets. And this, to me, is the big next driver of global capital flows. And I think that's where Bitcoin sits at a really interesting intersection of it all.
Right.
Yeah.
So the thesis is that people, foreigners particularly, are forced out or taxed heavily on U.S. equities, land, bonds, and therefore they find an alternative asset class to store wealth.
Yeah, exactly. And so that can look like a lot of different things. Obviously, one of the huge benefactors has been gold, which has been on an absolute tear for good reason.
Like 4% today as well.
Yeah, exactly. So, that's an asset class that is getting the bid from central banks, because central banks have foreign exchange reserves. They hold them strategically. They're not at the point yet where they want to own Bitcoin. I think that's a discussion for a few years from now, but we're seeing that in gold. We're seeing that in the euro, which is probably the closest currency competitor to the US, even though it's still very far away in terms of its ability to be a reserve currency. But still, you're seeing that diversification. And my argument is that perhaps a level down from central banks, talking about pension funds, insurance firms, and the like, I could see them start to diversify a little bit more into Bitcoin too, because let's frame this around what Bitcoin has been for the last 5 years. It's basically just been a risk on high beta correlation to US equities, right?
Yep.
So within that dynamic, it's been hard to really sell it as a unique asset. I think it's just been just a high beta play. But now when you incorporate what I just talked about, which is that we're going to put capital controls on the NASDAQ, on the MAG 7, I think that's still coming. It's a multi-year trend, right? Like we can have short-term bounces like we're seeing right now for sure. But in terms of where the flows are headed for the next 5 years, I think the case for Bitcoin starts to really emerge right now, because you're seeing, you don't really see capital controls on Bitcoin, right? It's more so going to be the benefactor of those diversification tailwinds. So I think this is all coming together in a lot of different cross currents right now.
Yeah.
So Felix, in the very beginning, when you were talking more about the actual, fiscal deficit and dominance side of things, and then now into the trade thing, one thing that you said that stuck out that I think is compelling to people is that the actual liquidity flows you think matter less per se than some of these more intricate kind of fiscal details. But one of the charts that gets the people the most bullish on crypto Twitter is just mapping the M2 and putting the Bitcoin chart over it and being like, look, guys, there's an 87-day lag. It happens every time. So are you saying that this is one of those correlation does not equal causation type of things, or saying that the reason for Bitcoin's potential future success, is more entrenched in these, let's just call them more complex reasonings than the smooth brain can just go like, look, chart go up, number go up type of thing?
Yeah, totally. So yeah, I would say it's a spurious correlation. And when you talk about spurious correlations, what it means from like a statistically trained perspective is that there's a third variable driving it that is unknown in the statistical analysis. So my argument, and I wrote this in that piece again as well, is that Bitcoin is a global liquidity asset. And so the reason it's been driven so heavily by the US side of things over the past few years is if you just look at fiscal deficits as a percentage of GDP, the US is at 7% of GDP. This is typically what the US government runs during a recession. So we're running a recessionary fiscal deficit during a positive growth regime. So no wonder it's been the key driver. But now you look at the rest of every other country, I'm in Canada. Our fiscal deficit percentage of GDP is only 2%. And people are shocked to hear that because they think, oh yeah, up here in the socialist communist regime of Canada, they must have a huge fiscal deficit. But no, it's been 2% versus US is 7%. And so my bullish dynamic is that every other country, because of the impact of what Trump is doing in terms of tariffs and talking about every other country trying to increase their percentage of spending for NATO and the military, et cetera, every other country is going to come and meet the US at those higher levels. So how this incorporates into the M2 dynamic, first off, my main criticism with the M2 analysis is that it's quite noisy. I mean, there's plenty of times in 2022 where liquidity, quote unquote, was surging higher and Bitcoin wasn't. It just so happens that we're in this regime right now. And so my argument is that the key driver is these powerful fiscal impulses. And that does trickle into M2, because when you have a high fiscal deficit, that's creating, higher interest payments. Higher interest payments leads to income for people that own T-bills. That leads into higher M2 growth. So my main criticisms are just a lack of specificity in terms of what are the actual drivers. So yes, for the most part, I feel like it's somewhat useful as a heuristic to just have a look at what M2 is doing and know that you're probably on the right side of things. But for practitioners like myself who are very passionate about macro, I'm more interested in diving deep into what are the actual causal drivers, because to me, again, that's just a spurious correlation. So, I don't have any big issues with it. I do have big issues when people start to look at every single tick and be like, oh, look, in a week from now, we're going to go down 4.458%. And it's like, that's just ridiculous.
Yeah. Man, so if we're looking forward then to, the end of Q2 into Q3, I'm quite bullish. I think you are as well. But you put out a tweet recently that said, July could be sketchy. Why is July sketchier than other months ahead? What's particularly got your attention there?
Yeah, so there's a few different short-term things. So yeah, put it simply, 8 to 16-month time horizon, I'm obscenely bullish. Short-term here, there's a few different cross currents that come together in July. So the first one is the positive economic data is in a bit of a weird, I've been calling it a mirage right now, where we've seen this today. We got the Atlanta Fed GDP now print, and it's at 4.6% growth, which is just absolutely insane. And a lot of that is just due to the whipsaw effects of tariffs. So we saw the negative print last quarter that got everybody in a fuss and calling for a recession. And that was just because of a huge amount of imports, which decreases GDP mechanically. And now we're on the other side of things, where we're seeing a huge slowdown in imports because everybody's already imported everything in the lead up to the tariffs. And that increases GDP. So you have this sequence, you have the pullback of the tariff announcements since Liberation Day, which is improving sentiment and business decisions. You can see this in the ISM survey data. So all of that together is creating this, I wouldn't go as far to say artificial strength, but some whipsaw dynamics positively, which we're in the midst of right now. And my belief is that'll start to end in July and August. So that's the first one. It's just that we've seen a whipsaw positively, and then I think we're going to slow down a bit more again here. So there's that. There's the tariff announcements in terms of this 90-day pause. That's coming to a head in July. We've already seen, I saw a headline right before jumping on that they're trying to get these deals done, get people to get other countries to have their proposed deals on the table in the next week or so. So a lot needs to happen very positively, very quickly. Trying to negotiate trade deals with 100 countries in the next month is a pretty insane thing to do.
Who's doing that?
Yeah. So
who's going to be on the phone? It's certainly not going to be Trump, that's for sure.
Yeah, exactly. So there's a lot of just tail risk, I would say, in terms of just not meeting expectations. And then the last one is the debt ceiling situation, which is the X date. So the day where basically, no matter what, Congress needs to figure out a solution and raise the debt ceiling, because the extraordinary measures and running down of the TGA account and all that, treasury wonkiness to keep them afloat ends in August. And when that happens, basically the Scott Bessent and the Treasury are going to need to go into the open market and issue $700 billion of Treasury bills. And somebody needs to be a buyer of that. And the last time that happened, the buyer of that was the reverse repo facility. So back then, I'm not sure how deep in the weeds your audience is on these acronyms and facilities, but basically there is, I think $1.7 trillion sitting in the reverse repo, which is money market fund money. They're the ones that are buying T-bills. So they were able to fund the rebuild of the TGA because of that RRP. This time the RRP is at like 120 billion. It's basically not going to foot the bill. So that needs to come from the open market. So you're going to have this sketchy moment, I think, in July and August, where they'll need to issue $700 billion and basically pull that out from the open market. And it'll all depend on who funds that and what they have to sell to fund it. But that will create some risky scenarios. But everybody's aware of this. The Fed's aware of this. Scott Bessent's aware of this. So I do think they'll have some sort of plan, which we're not aware of yet, but it's still something to consider. So those three things just create a lot of dynamics for disappointment versus expectations that I think is important to be wary of. But I'm not too concerned, because I do think they'll all be pretty well resolved.
Yeah, as I was saying prior to you hopping on, Jordy from Celine also kind of said something similar with regards to a potential slower summer than most expect. So seeing some confluence there.
Yeah.
So despite this kind of near-term rockiness in July and August, you still remain like overall bullish. So is that mostly due to the capital controls that you expect the U.S. to place on some of these other countries, and therefore liquidity phase in, or is there other fiscal impulses, maybe from Canada or other countries, that you're expecting will drive the market in a bullish direction over the next 8 to 16 months, as you said?
Yeah. So correct to all of those, basically. So there's a few different cross currents that come together pretty nicely. So you have every other country, in a reaction to the tariffs, is unshackling themselves from fiscal. So the big example of this right now is Germany, where they're pushing through like a $500 billion fiscal bill. A lot of it is like defense spending and military spending and that sort of thing. And alongside that, they've taken off what they have is this debt break regulation in their laws, where they can't run a certain percent of a deficit. I think it's like 0.5% or something, very, very low. So they've taken that off. They've unshackled themselves. And so you have this dynamic of all these different countries start to incorporate higher fiscal deficits, basically. Same in Canada. We just had an election, and Mark Carney is on the platform of we need to invest in our country and really just modernize our economy. So it feels like every country is going through this right now. So you have, again, just think of this idea. And at the same time, when I wrote that piece originally, this is where there was the narrative of the fiscal deficit in the U.S. was going to come lower. There was the idea of Doge and all this stuff. And we're starting
Austerity.
to see that, that's not going to happen.
That's completely cooked.
Yeah. If the bill
Elon's
passes
not
as
happy
it
about
is, if the bill passes how it is, it's going to actually go from 7% of GDP to 8%. So that's increasing. And then you have every other country that is going from the 0 to 2% range to probably like 5 or something like that. So you have every other country coming to the party to run their economy hot. And then, so you have that, you have the capital controls dynamic, which is going to lead to a multi-year decline in relative overweight ownership of US assets into other things. So I'm mostly interested in owning other things. I'm super bullish on gold, Bitcoin. I want to own, those rest of world equities. If you're interested in foreign bonds, those are looking a lot more attractive to US bonds right now. So I just want to be on the other side of things, of where all the money is going, because all the money is in the US right now. So you have, high fiscal deficits. You have this dynamic of capital controls, which I think is a unique benefactor to Bitcoin, all coming together. That these are very durable changes. That obviously, we can get these pullbacks in the summer like that, but I think it's the recipe that's setting up really nicely for Bitcoin to show what it was made for, which is just this, immutable asset that's not at the whim of these individual countries. So it feels like a really clean trade. I like owning it alongside gold. I think there's nice complementary ownership of both, just because of how their correlations sit. Like, we've seen a little pullback in Bitcoin, and gold is up like almost 3% today, for example. So it just feels like they're all coming together, and they're very long-term changes. It's not just going to be like a quick blip. So it's trying to just sit back and let it work its way through, and not get too chopped up in these summer months, which could be a little bleak. And it's looking good on that long-term horizon.
Yeah. Quick follow-up on these fiscal deficits. You mentioned America's already at a 7%, but most of these other countries are somewhere between 0 and 2% fiscal deficit. Why is it that this is a follow the leader sort of dynamic? If America goes up, is it because they're trying to keep their currencies in balance, why is it that the rest of these countries are going to start to run their economy hot as well? And is this there's a follow-up to that question as well around, the national debt and kind of a slippery slope to hyperinflation. Maybe you can get there. We'll pause after this, the fiscal deficit follow the leader dynamic.
Totally. Yeah. Bringing up the point of the currencies is important because that is where a lot of these effects will actually net themselves out. So, a lot of what we talked about at the beginning in terms of trade could easily lead to a regime for the next couple of years. And this is actually another bullish factor, which is that I think the USD is in a pretty major cyclical downturn. I think it's obviously we'll see like small oversold bounces higher, but I think, I've seen some analysis of like a 20% decline in the US dollar on the table. So I think that's totally reasonable. And a lot of the reason for that, so FX is super confusing because there's always like a pair to it. So if you think about, and it's also an expression of rate differentials. So we'll walk through this here, which is that, okay, other countries are going to increase their fiscal deficits, spend more money. That is going to lead to higher inflation, higher growth, higher bond yields, which is going to lead to basically that relative to the US, which is already at that level. So they're going to catch up. And so overall, you're going to see, because of those higher bond yields, more capital going back home to these countries because on like an FX hedge basis, it's a lot more attractive for them. So yeah, there's that dynamic basically where the impact and results of the trade is going to lead to these recalibrations in FX currencies. So you have that, plus you have the geopolitical dynamic of, being like, oh crap, we can't rely on the US for everything anymore. Like, it is a fact that the US has been footing the bill for NATO for too many years. And, countries like Canada, where I'm at, need to step it up as well. So we need to do that. We need to increase our defense spending. We need to increase, our investment into just being more resilient as individual economies across the world. So there's a lot of fundamental reasons. There's geopolitical reasons. And then there could be, like currency agreement reasons as well, which is that to net out in the most clean manner everything they want to do in terms of normalizing the trade situation is a major weakening of the US dollar. So it's not one answer. It's a lot of different moving parts, but they all go into that direction. And yeah, happy to talk about how that leads into this fiscal path situation that you talked about in hyperinflation.
Yeah, because Ray Dalio and some of these guys are talking about this inevitable death spiral that is caused by us printing money to finance our own debt, and interest rates continue to go up as we continue to finance that debt, and we have to print more money, and the cycle continues. It feels, as you described the situation, a runaway train. We're at 7% now. That is increasing. We're not going to get to this 3-3-3 plan that Besson and Dalio are trying to get to. So where does this end? Do we ever bring it back down to earth, or is this really a runaway train?
Yeah. It's such a difficult conversation to have because yes, the fiscal path is unsustainable, but it's probably also unsustainable for a lot longer than most people think. So, if you just look at interest payments, right? If you look at it on like a unnormalized basis, like just the raw numbers, it's just a vertical line right now. But when you look at it as like a percentage of GDP, we're actually still within a range. Like, we're not at all-time highs yet. I think we're still roughly around where we were in like the 70s, which was the last time we saw really high bond yields. So within that dynamic, I would say there's still a lot more runway. It's just that the path is unsustainable. And, I think Chair Powell is pretty correct in how he describes this, which is that the path is unsustainable, but the current level we're at is pretty sustainable. So yeah, if you're running a 7% of GDP deficit like we are right now, and then you go into a recession, suddenly we could end up with, just because of like the automatic stabilizers that occur in a recession, we could easily see the deficit double to like 15% of GDP very easily. And in that situation, it's also a bit sketchy, but it's just about the path of how long you can sustain that. So I think overall, it's not sustainable, but it's more sustainable than most people think in the short term, is my opinion. Now, there's also different dynamics and policy choices that they can make to keep this ball going for a long time, with the end goal of running it hot, which is sort of what we've seen has been the policy pivot of the last month, where we've seen Scott Bessent come out and say, we want to run a high growth regime and outpace the debt because the debt is fixed, but the GDP is a nominal term and nominal metric. So you can run the economy hot, and then suddenly the debt load becomes a lot more manageable because the levels stay the same. It's fixed at those levels. So the goal is to get to that point and basically just run the economy so hot that the debt becomes manageable. But there's a lot of speed bumps that can hit in that process. So one of the big approaches we've seen is this focus on issuing T-bills rather than long bonds. So this has been the policy that originally is Yellen who implemented it under the Biden regime, and we've seen a continuation from Bessent, despite him being a critic of the policy, which is pretty funny. But overall, it looks like, you know, there's no plan to increase coupon issuance meaningfully on the long end for at least the next year or so. So this shift to T-bills, there's almost unlimited demand for T-bills in the world. But the trade-off for this is higher inflation. You know, T-bills are basically printing money versus when you issue long bonds, they're a lot more like a risk asset in their characteristics. So you can do this for a long time, but it will include higher inflation. And it's just, I feel like it starts to become more of like a social dynamic in terms of like how much can society be okay with that before it becomes, you know, you start to vote people out and that sort of thing.
Yeah, especially with the widening kind of wealth gap, as well as in these inflationary times, you know, it just kind of, it affects those in the higher classes in a positive way. Asset appreciation, and then those who don't own assets are unfortunately subject to, you know, likely very little change in wages, but higher prices for goods. And so it just becomes a problematic scenario. I mean, that's what we saw in 21. People were calling for a double inflation back in 21. We were calling for the soft landing and then a double bubble. Not sure. Obviously, we haven't had that quite yet, but subject to change if tariffs do stay on and you know, cause that kind of inflationary spike. That seems like what the Fed is basically bracing for. So that kind of brings me to my last thing for you, Felix, before we let you bounce off. If you were in control of the U.S. tariff policy, what would your policy be and why? And perhaps it's, what changes would you make? What indicators would you look for to inform your choice? Well, what would your tariff policy be now?
Yeah, I'd go after the capital account surplus. I think it's so much more feasible for society to buy into that, because what are you doing? You're taxing rich people. You're taxing rich people from other countries. Like, that is just a win for almost everybody. Versus if you're going on the tariff side of things, what are you doing? You're taxing goods that people need. And, you know, you're taxing pharmaceuticals and that sort of thing coming from China. Like, these are these are things people need to live every day. So I would heavily focus on the capital account side of things, and I think that's where it's headed. I would put in more stringent capital controls to get people to not be so overweight US, and that would, you know, it's the laws. It's a law of nature, balance of payments, which is that if you do that, it'll lower the current account trade deficit as well, without the need for tariffing your allies and that sort of thing. So I think that was a huge mistake, is the approach they took. I've kind of held this view that the issues that they're trying to solve, I agree with. I think this huge trade deficit that the US is running is not sustainable. You know, China has been taking advantage. Other Asian nations have been taking advantage by having artificially weak currencies. Something did need to change. It's just the approach of it has been very not great, and we've seen that in the walking back. And so I do think that they're on a better path now if they focus on, you know, running it hot from a fiscal perspective, paired with some of these capital controls on the capital account side of things. I think you can get to a more durable trajectory to normalize these balance of trade issues without getting, you know, the middle class to be the bearer of it all. I think that was a very significant mistake, and it does feel like they're heading in the more correct approach to it now, and that approach is very bullish Bitcoin in my opinion. So I'm not mad about it either.
Do you think these other countries are kind of bracing for that and saw that coming, and, you know, that led to the creation of BRICS? Do you see BRICS as a real threat?
Maybe a little bit. I mean, yeah, basically every country is trying to diversify out of the US dollar a little bit. Whether that's gold, whether that's a BRICS thing, whether it's just owning more of other currencies like the euro. Yeah, the trend is in that direction. Absolutely. this dynamic is not sustainable, especially when you start to weaponize the US dollar like they did with Russia.
Yeah.
Suddenly
that
was the moment. I mean, that's when, like, if you look at a correlation of gold to real rates, that was the breaking moment. Suddenly, for decades, gold has been correlated to real rates. So, when you have negative real rates, gold does really well. And suddenly we got into this regime of really high real rates, and gold was still doing really well. And you can basically look at a chart of the day that happened, where they weaponized the US dollar SWIFT system as the moment where suddenly every reserve manager in the central bank was like, oh crap, we need to diversify our holdings. We can't just own US treasuries.
Felix, one last question for you. A lot of the things we talked about today point to a weaker dollar through running the economy hot. The one counterfactual here is this dollar milkshake theory that Santiago Capital talks about, and on the face of it, it seems really, really compelling that the dollar will get stronger through like 3 different counterparts. Do you think there's any merit to the dollar milkshake theory? And if so, why or why not?
Yeah, I was a big fan of the dollar milkshake theory. Still am. I don't think Brent thought that the US would be the one to catalyze this regime shift. I think he thought that they would be the ones that would be the last to this table. Because again, like, the approach of doing what I said in terms of capital controls is a major systemic risk to the US dollar reserve hegemony. So I think he thought that we wouldn't get to a moment where society and policymakers were at a point of being willing to do this. So I think it does question the thesis in a lot of different ways, because the issue was, or the dynamic that was originally there for the milkshake theory was that every other country is just in a so much worse situation than the US. But suddenly we're in the opposite regime. We're running, like, the US is running the highest fiscal deficit. The US is the one saying that we want to, lower the capital account surplus. So I think you have to reevaluate it in a lot of different ways, because the fundamentals have shifted.
Felix, thank you for joining us, man. Appreciate your time. Love your work. And we'll have to get you on in like 3 to 6 months and do a recap of what's going on, because it feels like every week is just accelerated and there's just something going on. So
thanks guys. I really enjoyed that, and would be happy to come on again.
Speak to you soon, man.
Thanks, Felix.
Thanks,
Cheers, man. Yeah, man. There seems to be this recurring confluence of the summer being well.
Yeah. You started to sound like a bear.
I mean, that was the most bullish macro conversation I've had in a while.
Exactly. And so, you may get a little bit of a slowdown July and August. Maybe that, I mean, look, we're in the summer right now. It's the first month of summer. And I do think that Q3 is poised for just more of what we've seen. Now, it does feel like it's almost like that last rally before a mini downturn, like, because we did get, we got some moves upwards over the last few months, and that started to dwindle, and it hasn't had as much momentum as it had earlier in kind of the spring. And so I think there is some truth to that, but ultimately that is enveloped by bullishness in the spring, bullishness in the winter, and so on. And so, when you're considering this, like, how short term are you thinking, right? Are you going to try to trade the top and take some off the table if you're expecting a summer downturn, or are you thinking just ride it through?
Totally just ride it through.
Yeah. Well,
been holding for way too long to like start to get into macro predictions on the 1 month time frame. But I think it's helpful context to understand as an investor as to like the more like, I mean, this being the third time being in like a cycle per se, like my goal is just much more to like make like one trade, like, one like big trade, not like one asset, but like one big like buy low, sell high type of like vibe where it's not just like flip flopping. And so like I think just getting caught up in the summer slowness is just like a flip flop. Like to me, it's like, yeah, okay, the summers are always kind of slow. And it doesn't mean it has to be like that. Things could change. But basically what these guys are saying is that based on the current, as Felix said, kind of whipsaw, that the summer being slow, tends to make some sense. So anyway, next we got Loris from Multiplier. Let's get him up here. Excited to hear from Loris. And I know that these guys have been shipping really, really cool consumer products on Abstract and more. So why don't we pull him up and let's get started.
Hey, everybody. Just doing a little mic check.
Yeah, man. I think you're good on my end. You're in the city, right?
Yeah, I'm at the Alchemy HQ in New York. Shout out to Glenn for actually giving me a conference room while trying to find a place to settle down.
Yeah, I know Glenn is a good guy. I didn't realize that.
He's a great guy. Yes, he is.
They have the office out there, right?
Oh, it's absolutely amazing. Yeah, they have an office here. It's a really great office.
Yeah, cool, man. Well, welcome to the show. I know it's your first time on. Man, what is multiplier.fun? Who is Loris? Let's just start there. And we got a ton of good questions for you.
Yeah, let's just shoot into it. Started off my career in TradFi, got into DeFi in 2021. Helped a few DeFi protocols when it comes to mechanism design. Started off a little dev shop that actually turned into initially we started building an NFT finance protocol, raised the pre-seed round from a lot of great angel investors and VCs, but NFT finance kind of died. So I think I made a Twitter post about this, like, hey, like the market's dying. There's product, there's market to get the product market fit. So we got to figure out what to do next. So I was talking to a bunch of people on, what we can do, what we can figure out. We decided to build this gamified experience where people can win cool stuff in a way where we don't hold inventory. And that's something we launched on Blast. Right when Blast came out, shout out to Jez for actually convincing us to go to Blast. And yeah, ever since then, we've been on the consumer app trail. And that kind of led into what Multiplier is right now and what Multiplier will be a few months down the line.
Yeah, man. You know what's funny is I was looking at some of your tweets and on your fundraise tweet and then your giving capital back tweet, you wrote just quote unquote, "I fucked up," which is kind of a banger way to start this tweet. Don't mean to just throw you on the spot here, but what were some of your takeaways looking back? What advice would you give to somebody raising capital in the space?
Well, to anybody raising capital in the space, my first piece of advice would be, and bear in mind, we've only raised the pre-seed round because we've been cash flow positive for the past 18 months with every single thing that we built. But raise money when you need to. And all I'm going to say about, that entire tweet, I really don't want to talk about it that much, but that tweet got 250K impressions. Smokey was replying to it. Jesse retweeted it, right? So L1 marketing budgets and champions. That's all I'm going to say. Distribution is king. Cool.
Okay, well, Multiplier has been pretty popular on Abstract as of late. And you have some news for us, man. So let's just start first before we dive in. We'll dangle the carrot just a little bit longer. What made you guys choose Abstract to start, and why was Abstract attractive as a builder, and why is it?
Yeah, sure. So there's two ways to think about it. So ultimately, Multiplier is a DeFi protocol, right? There's two ways to think about it. We use two positioning statements. The first one is the people's market maker, because people can curate coins, users can curate coins, and if people play the games that we build or third-party devs build, every single wager injected into the app injects lick into the LP of the token, making it go up, right? So we've had multiple case studies on Abstract where we've, curated a coin and made it go from 100K to 20 million in just a few weeks, right? So a good way to think about the entire platform is that we're an affiliate platform for on-chain volume. And when deciding to go to Abstract, what we wanted was, a full tabula rasa, something that's completely fresh, something that's completely new, where we know that, devs are going to be launching coins and where we can effectively test out the mechanism that we built out, that we learned to build out from the previous products that we built in a completely fresh environment. So it was a calculated risk on the team. And I think the team has performed tremendously well. I can rant for 10 or 15 minutes how Abstract kind of took the Blast model and extended it through, gamification. We knew those things were coming up before we launched, and as a calculated risk, as a great launch point for the business that we're building, the protocol that we're building, I think Abstract was, it was the perfect environment to get started.
Beautiful. All right, well, let's unveil the news then, Loris. We have Multiplier, Fun, the people's gaming, gambling, and fun platform.
Yeah. So more or less, what we've always wanted to do was build out our own games, and with every single game, whenever a user wagers, that link gets injected in a token. So I don't want to repeat myself too much here, but ultimately we see ourselves as positioned between launch pads and dexes, or more mature trading venues in the liquidity stack, right? So we see ourselves as a gamification layer for, token launches, pre-bonded tokens, launch pools, etc. So we have effectively closed the deal with a $2 billion market cap protocol to become a gamification layer for them. I can't say who at this point in time, but ultimately what we want to do is our products have generated $24 million in revenue over the past 18 months. We generated $6 million in net profit over the past 18 months. I don't think a lot of consumer teams in crypto can actually, testify to that kind of track record. And that's coming from the games that we built ourselves. And it's all positive sub fun, right? Once again, every single dollar spent is used to pump tokens in an ecosystem, right? So it creates this circle reflexivity. So what we want to do is partner up with a major infrastructure partner in a major ecosystem so that we can take our results, take our technology, take all the incentive design, the mech design that we developed over the past 18 months and just try to 30x this, because we know that it works and we know
I've made an outsized impact.
Sure. So there's 3 dashboards that we obsessively check every single day in the team. And first of all, when everybody joins the team, we're a pretty small team. We're just 8 people, right? There's a great book called The Mom Test. It's an old SF, product development Bible. Everybody has to, I reread it every single year. We do customer development research, user research on a bi-weekly cadence. But what we kind of figured out over the past 60 months is how to get really good conversion rates, right? So for our last product, the one that effectively was a prequel to Multiplier, where we took that mech design, where we learned that, hey, this people's market making system works, where these, how can we pump assets without holding those assets in our inventory and taking that inventory risk? Well, we wanted to build a cool UI around it, right? So we were playing around with things and tinkering until we got to a 40% conversion rate. And even on Multiplier right now on Abstract, what we have is whenever a user lands, there's a 52% chance that they will convert into an activated user, which is honestly, I would have to say, the biggest accomplishment that we have in the team. The revenue, et cetera, that is, irrelevant. Revenue can change, markets can die, narratives can die, but that's a huge accomplishment on top of week-on-week retention cohorts. I forgot the name of the guest on your podcast. I think it was somebody 5 or 6 weeks ago. Is that really there has been a narrative shift or a meta shift where, even investors are encouraging builders, hey, just, don't talk about the token at the very start, figure out how you can add value and actually make money. And that puts you in, a position of power whenever you want to execute on broader plays. And that's kind of the whole strategy that we've had internally within the team. Make sure that we're cash flow positive, make sure that we're delivering value, have a hit rate of 60 to 70% of our PMF hypotheses, and only then figure out how you can move up the value chain. So start with an app and figure out how to build infrastructure on that.
Yeah.
Function perspective, it's a decreasing linear curve, right? I'm definitely not going to con. First of all, it's expensive. We're pretty meticulous about cash flow management. What would make me go to a conference? A very superficial answer is all my friends are going there, and kind of makes sense for me to go there from a business perspective. But secondly, it needs to be very well orchestrated, organized. Honestly, the only 3 conferences that I are Token 2049 in Singapore. I always go to ETH Denver, and shout out to the Solana Foundation for Solana 𝘗𝘳𝘵𝘁, because it was one of the best conferences we've ever been to.
I mean, I was just curious about kind of some of your conference thoughts, because I saw that tweet, and I haven't been to a conference out of New York City either. There was Dubai, that was, and I was and then there's there's been a couple in the last month.
Yeah.
But I'll be at permissionless. So I think that'll be a good builder conference.
That's going to be a good builder conference for sure.
Yeah. All right. Well, kind of just wrapping up, man. Just a random question about some of the direction about the art around multiplier. Kind of gives like this 8-bit aesthetic vibe. How'd you guys settle on that?
I think we just like, the entire team is like CT native. It's like we worked our Truffle Suite, Mangrove, Open, a lot of great companies. Like we have a very like CT native culture. We're also not targeting a user audience outside of CT. Like I'm going to be very explicit and opinionated about that. We know exactly the user personas that we're targeting. There's several, and they're all pretty like crypto native. So kind of like I would have to say not necessarily like a cyber funk or punk aesthetic is what we're going for, but we wanted to like create a sense of nostalgia, right?
Yeah.
And like nostalgia is a common mimetic qualia throughout the entire space. Jess posted this tweet yesterday about, this is where I learned to trade. I think it was, Runscape or something like that. Other people were posting Osha. Yeah, exactly. So that's kind of like the mimetic quality or like the cultural alignment that we wanted to go for the app, right?
Yeah.
As we're moving up the value chain and as we're capturing more of the liquidity stack, that's going to obviously change a little bit. For the app, I think it's worked perfectly.
Rob, you got anything? Are you out of there?
Yeah, I'm here. I been patiently listening. I had some tech things on my side, but I think from my point of view, you guys have done it the right way. Like you've operated this like a real business. You've targeted a market. You've capitalized on that market, and you let the token come later, right? And so you're operating this like a true business, and you're letting the product suite develop. And I hope other projects take note and look at the success that you guys have driven, and find success in their own right.
Thank you. It's definitely it isn't easy, but ultimately, I think it's also good for like team morale. If any other like early stage builders listening, because nothing beats like nothing is gonna turbocharge your engineering team by seeing like massively improved metrics, right? Everybody just wants to ship harder. Everybody just wants to execute harder. You actually talk to real users, right? You're seeing how you're delivering value. If that value is, frankly, in our case, like multiplayer finance with like Ponzonomics on top, right? You see those metrics, you see how people are enjoying it, the things they're seeing, and it's a massive like it truly creates a spirit of core, and I couldn't imagine building any other way. But that's just me, right? Everybody has a different playbook. That's just like the playbook that I've settled on.
And I think the market has reciprocated that. I actually saw a study just the other day that said NVIDIA was one of the top 5 places to work. And it looked at office culture and longevity and all these things. I was like, yeah, no surprise that the stock that's up, however many X, right? It's one of the best places to work because all their engineers have stock options.
Yeah, exactly. Everyone's just coming into work gassed up.
And you're on mute there in the Google Meet. I hear you chirping in, but I mean, look, absolutely, right? And it's the same goes for crypto and token prices. And engineers are going to be motivated not only by token price, stock price, but also by user metrics. Ultimately, you guys are trying to provide something and build something of value that real people find useful and valuable.
When it comes to like first principles in hiring, and I think I've made a lot of mistakes, and only now I'm getting it right. Is like you want to find extremely greedy, neurodivergent people. Extremely greedy, extremely neurodivergent people. But the greed is just as important as the neurodivergence, right? You want people who want to lock in. You want people who are going to talk about your equilibrium-based risk model with a constant product function at 11 p.m. on a Saturday, right? If you don't have that culture within the team, you're just not going to make it.
Could you explain why neurodivergence is such an important characteristic to have in success?
Well, I think it depends. Look, let's be real. We wear like anime PFPs on a social media platform, and we have like a lexicon of vocabulary, like a mimetic kaleidoscope of concepts that I don't think any like normal person would understand. I think to be successful in this industry, you just have to be a little bit weird. But that's the thing that attracted me in the first place, right? I came in with the idea that I'm going to bring the securitization stack on chain. At the end of the day, I'm building, a gamification layer so we can build better Ponzi's on chain.
We love you,
Lois.
Lois.
The future of France, definitely.
Lois, thank you for joining us, man. Congrats on the success. Excited for your multi-chain expansion and looking forward to hearing more and seeing more of what you guys do. My friends are juiced up about the airdrop, juiced up about the platform. So people have been having a lot of fun.
It's just getting started. Really, this is just the first inning. Stealing this from Pump Fun. All right, take care.
Thanks, Lois.
Soon, man.
Thanks for having me. All right.
Cheers, buddy.
Man, you're not going to find commentary like this anywhere else. All these other podcast TV streams talking about the success of neurodivergence in early stage crypto tech startups. You're not going to hear those takes anywhere else.
Man, pretty good stream for a Monday. Quite a bit of all over the place though, but we survived. We pushed through. We made it happen. And yeah, I mean, Felix's segment was amazing. Jackie's was too. DeFi Dojo had just so many fire yield takes. Yeah, and then Loris just kind of dropped the bomb that they're not leaving abstract, but they're expanding outside of abstract. Meanwhile, Laudio token is absolutely under 6 mil. BTC is down. I lost again. Trend is really down.
We got to put something on this.
Hype is breaking now. I don't know what's going on there, but
maybe it's the buybacks. Maybe it's the real revenue in the buybacks.
I don't know, man. I think it's this James Wynn guy pumping the damn out of it. But Rob, fun stream, man. Thanks for joining there. It was fun.
Hey, man. You're not going to get rid of me this easily. I'm not going anywhere. I'll be here tomorrow. I'll be here Thursday. I'll be here next week. And we're gonna keep our production guy real busy. 24/7 coming soon. You guys just wait.
Alrighty, boys and girls. Thanks for tuning in. We'll speak to you soon.